How exactly does a highly vulnerable agrarian economy bridge a massive climate funding gap? Well, that's exactly what we're going to decode in this explainer. If you've ever wondered how large-scale environmental resilience is actually funded on a national level, you are in the right place. We're going to walk through the exact frameworks, mechanisms, and assets being deployed right now to secure a sustainable future.
But before we get into the financial mechanics, we really need to confront a rather brutal irony. Less than 1%. That is Pakistan's total contribution to global greenhouse gas emissions. Less than 1%. Yet, despite this tiny footprint, the country consistently ranks among the most globally exposed nations to catastrophic climate shocks. It's a stark baseline fact, and it really sets the stage for everything we're about to explore.
Okay, let's dive right into this. Climate finance and green bonds in Pakistan. We're talking about mobilizing capital for climate resilience and green growth. Think of it like channeling dynamic financial currents directly into the physical landscape of a country to protect its future.
To understand why mobilizing this capital is so absolutely urgent, we just have to look at the dual threats the country's facing. On one hand, we've got the agrarian threat. Extreme heat waves are severely straining power grids and public health, while glacial melt and erratic monsoons are threatening the long-term water security that a primarily agrarian economy relies on. And, on the other hand, there's the infrastructure threat. Reoccurring monsoon floods, like the catastrophic events we saw in 2022, continually destroy critical infrastructure and displace millions. So, who pays for this? The fiscal reality is that the capital required far exceeds the available public resources. Private and international capital isn't just helpful here, it is absolutely essential. When we talk about actually bringing that capital in, we're essentially looking at two different pipelines. First, there's mitigation finance. This is capital directed at reducing or avoiding emissions altogether. Think renewable energy, clean transport, and energy efficiency. But just as crucial for Pakistan is the second pipeline, which is adaptation finance. This is capital specifically directed at strengthening physical resilience. We're talking about flood defenses, drought-resistant agriculture, and robust water management. Both pipelines are needed to move from a state of intense climate risk to a solid foundation of resilient infrastructure.
So how exactly does a nation attract this kind of funding? Well, it happens through a highly specialized climate finance toolkit made up of 4 interlocking gears. First, we have blended finance, which uses concessional public funds to de-risk and mobilize private investment. Then we have carbon credits, which incentivize low-carbon investments through tradable units. And then we have the heavy lifters of the debt market, green bonds, which are your conventional fixed-income instruments, and green Sukuk, which channel Islamic capital directly into environmentally sustainable physical assets.
What is incredibly interesting here is the contrast between those last two instruments, green bonds versus green Sukuk. While a green bond is a conventional debt instrument where an investor earns fixed or variable interest, a green Sukuk is entirely Sharia compliant. This means the investor earns rental income rather than interest. Furthermore, while a bond represents a promise to repay a debt, a Sukuk represents actual partial ownership of the underlying green asset itself, like a solar plant or a dam. It's a fascinating structural difference, and it opens up access to massive pools of Islamic capital.
Now, none of this operates in a vacuum. The market ecosystem functions a lot like a massive orbital structure. Right in the very center, acting as the anchor of the entire system, is the Sovereign Sustainable Finance Committee. They coordinate policy across the Debt Office, Planning Commission, Climate Change Ministry, and the State Bank. This inner anchor then connects with core facilitators like the Ministry of Finance and the SECP, drawing in domestic and international institutional capital from the outer orbit, all with the help of multilateral development banks and commercial Islamic banks.
As you can imagine, building this ecosystem didn't just happen overnight. It started back in 2021 when the SECP issued the initial green bond guidelines aligned with international standards. Then in 2023, the National Adaptation Plan outlined actions to strengthen resilience alongside emissions targets. But the real momentum leads us to some massive milestones coming up in 2025. In May 2025, the inaugural Green Sukuk is issued, followed by the formal establishment of the Sovereign Sustainable Finance Framework in September of the same year.
Let's talk about that September 2025 Sovereign Framework for a second, because it really serves as the ultimate anchor of trust. The absolutely crucial point here is that this framework received an excellent rating by Sustainable Fitch. This isn't just a pat on the back. This independent second-party opinion essentially transforms Pakistan's green instruments from novel domestic initiatives into globally trusted, institutional-grade assets. It literally tells the global market, hey, this system is rigorous, transparent, and ready for your capital. And you know what? That trust translates directly into action. Let's look at the specifics of that monumental May 2025 inaugural sovereign green Sukuk. We're looking at an issuance of 30 billion rupees. It has a 3-year tenor or lifespan with a variable rental rate using a strictly Sharia-compliant Ijara structure. Listed right on the Pakistan Stock Exchange, the proceeds are exclusively directed toward eligible green energy initiatives, specifically hydropower generation and dam construction. It's a massive proof of concept executed with a syndicate of major Islamic banks.
To really grasp just how secure this system is, let's walk through the capital pathway. It all starts at the source. This is where domestic and international institutional capital first enters the system. Think of it as raw financial energy being gathered from global and local markets, just waiting to be channeled into something highly productive.
But, of course, that raw capital doesn't just flow wildly. It hits a rigorous structuring filter. Here, the framework design and external reviews ensure complete alignment with ICMA and Sharia principles. Once the capital is verified as green and compliant, it moves straight into the execution phase, where it's officially priced and auctioned via the Pakistan Stock Exchange. The whole system is designed from the ground up to be highly regulated and fully transparent.
Finally, before a single rupee is even spent, the funds enter the protection vault, a strictly ring-fenced escrow account separated completely from the general national budget. Only from this highly secure vault does the capital branch out into actual deployment, funding things like renewable energy, sustainable agriculture, and clean transport projects. And this entire process relies on independent environmental impact reporting to generate continuous yield returns right back to the investors.
Of course, any emerging financial market faces a bit of a balancing act. On the opportunity side, Pakistan is uniquely positioned to become a premier regional hub for Islamic green finance, backed by growing global ESG appetites and that excellent Fitch rating we talked about. However, these advantages must balance against some very real challenges. There's limited domestic market depth, capacity gaps in generating bankable project pipelines, currency risks that can impact international appetite, and the ongoing demand for rigorous, standardized ESG reporting.
To ensure those opportunities actually outweigh the challenges, the long-term foundation is built on 3 distinct pillars. Pillar 1 is all about market expansion, deepening liquidity and mobilizing private capital through blended finance. Moving to Pillar 2, this secures structural integrity, making sure domestic disclosures are perfectly harmonized with international benchmarks and the UN Sustainable Development Goals. And finally, Pillar 3 guarantees access and pipelines. This means actively investing in the technical capacity to actually structure these climate-resilient projects, while expanding market access through international and sub-sovereign issuances, like local government or municipal bonds.
Ultimately, all of this builds toward one core goal, the resilience loop. Institutional capital is raised via the sovereign framework, which is then channeled directly into adaptive infrastructure. That infrastructure mitigates physical risks, shielding the economy from extreme heat and devastating flooding. By mitigating those risks, you generate national economic stability, which directly secures the investor's yield, thereby attracting even more capital. It's an incredible, continuous, self-reinforcing cycle of sustainability and economic health. Which brings us to a really powerful conclusion. Climate finance, green bonds, and green Sukuk are moving from pilot to policy, positioning Pakistan to mobilize the capital its climate resilience demands. This isn't theoretical anymore, folks. It is active, structural economic policy. It leaves us with a truly provocative question. As we watch real-time financial engineering step in to literally save physical economies from the forces of nature, how will other vulnerable nations adapt this blueprint? If you found this breakdown of Pakistan's green financial architecture valuable and want to dive deeper into ESG, sustainability, and climate policy, I highly encourage you to scan the QR code to subscribe to the ESG Insight Hub. Keep learning, keep questioning, and thank you so much for joining me for this explainer.